In the 1800s. I can't remember the exact time, but obviously you can Google that. And it was a way to hedge price risk. So for farmers that were trying to sell corn, obviously, the majority of the year they wouldn't have corn to sell, and then all of a sudden, at one time in the year, there'd be just a ton of corn, and the price of corn would fall drastically. And it was really hard for them to figure out how to make a living. It was hard for the buyers to figure out how to make that work. And so futures contracts were invented to agree to buy a certain amount of product at a future price. And so what we do is we trade the fluctuations on that price now, and we make money. And it's not terribly dissimilar to options trading. So if you've been doing options trading, it's going to be very similar to options trading. Key differences are you don't have calls and puts, effectively, and that's the difference. So one key benefit to trading futures that you do not have in options is you in futures there is no theta decay. So one of the risks in trading options is you might get in at the perfect level, but it might take a while for it to break your way. And if it takes too long, you're taking a loss just because of the time. In futures, you do not have that risk. You only you're only positive or negative based on the price action. So you don't have to worry about the timing as much, and it makes it a lot more straightforward and a lot simpler. Um, so that is in terms of trading options versus trading futures. If you can do options, you're going to be really good at futures. It's a lot easier, a lot more straightforward, and I think people get confused in terms of thinking that it's going to be much more difficult when honestly it's a lot more straightforward. Excuse me. Some nuances to trading futures that you are going to want to know. So if you're used to trading SPY or QQQ in options, it's going to be a little bit different in futures. So the strategy is going to be the same. You can use the exact have difference in price movement. So and it'd be 5 points as well, but a tick is only worth $5. However, NQ moves a lot more than ES, as you can see. So the chart here, NQ is currently at 456, and ES is at 5,000 futility. Then you have on ES and the risks. You need to understand the tick value for the product that you're trading. Tick values are easily found with a Google search, and there are a ton of products that you can trade depending on your broker. The ones that I like to trade are going to be the NASDAQ or NQ, S&P or ES, and crude oil, which is CL. There are a lot of other ones. You've got gold, platinum, copper, silver, natural gas, all kinds of different products. You need to understand their ticks. I'm going to trade 3 contracts. All right. So you get in your trade.
Order filled.
And we're going to target this high. I don't think it's going to make it there, but I'm just doing $735 on this 3 contracts in this trade. Worst case, I lose. I still have the ability to take at least 2 more trades on the day before I hit my daily loss limit. And if it hits my take profit, then I'm going to make $1,700. So my risk reward on this particular trade would be just a little bit over 2 to 1. But those are important things to know. You need to make sure you know your tick values. You need to understand the market that you're and the news that affects that particular market, because the news comes out all the time. You want to make sure you monitor that, and you want to see what it's going to do and how it might shape your particular product. If you trade crude oil, for example, every Wednesday, 10:30 a.m., the EIA releases the crude oil inventory based on what their against what their estimate was. It is always really wrong one way or the other. It's never even close. It's usually really wrong one way or the other, which provides a lot of volatility in the marketplace, and can make you a lot of money or lose you a lot of money. It just depends on the trade you're on. One of the things I will say that I think my favorite about trading futures are the prop firms. For a long time, for a few months, I guess about 6 months now, are relatively easy to pass. Their payouts are reliable and dependable and easy to get. So I love Top Step. There are some other really great prop firms out there. Apex Trading is one. take profit traders are not so great good at trading, and you blow up your trading combine account. All right, you lost $50. Leverage that you can lose a lot more money than you're actually putting in. With prop firms, you're risking the amount that you put in, and that's it. And you actually can get payouts on that. So with Top Step, you buy a 50K combine. If you pass the combine, you pay a $149 activation fee. So all in, I'm at $200. To get a payout, I have to have five $200 days in a row. Okay. So you make $200 in 5 days. They don't have to be in a row, but they can be any. I can take a payout of up to half of what I put in it. I can take a payout of $500. I still have $500 in my account, and now I'm up $300 on the transaction. It's a pretty solid deal, if you ask me. Um, if you're going to trade prop firms and you want to take a payout, I would recommend that you get above what your maximum loss limit would be. So typically on a 50K account, you want that I would recommend doing that. About prop firm specifics, I would just say, depending on the prop firm you are working with, I would refer you to their particular website for those.
Order filled.
So I've lost $753.40. That includes, I know that I've had a ton of questions, but prop firms, I get a lot of questions about prop firms. I just want to make sure that you guys really understand the firms that you're working with and know what you're doing there. Let's see. Okay, so now we did talk about products. Again, they can vary by. It's a contract. Each contract expires at a given period with the indices, uh, ES and NQ. Those are those expire at every 3 months. So January, February, March, first quarter. That's the first contract. April, May, June. That's the next contract. So it would be the June contract. It's always a forward month. So in this case, it's NQM and ESM. That M stands for June. For crude oil, currently trading the June contracts because it has the highest volume, but rollover or contract expiration occurs every month in crude oil. So the last week to 2 weeks of the month for crude oil tend to be kind of choppy because you have larger companies now, settlement. A lot of things are occurring during that time, and that's something that you're going to want to be aware of. With the indices, that's every 3 months. So the last 2 weeks in June are going to be really gross on ES and NQ, unless there's some kind of massive news catalyst. But you're going to tend to see a lot more chop during that time. So the last 2 weeks of March were choppy. The last 2 weeks of June are probably also going to be choppy. What you're typically going to see is the last week of the month, almost everybody is trading on the forward contract or the next contract. And you'll want to make sure that you're on the contract with the highest volume. Your broker is typically going to have that information available to you and roll your contract forward so that you're trading on the highest volume contract, because that's where you're actually going to make your money. Lines, rules, and what you can do and can't do. You need to make sure you understand the ins and outs of whatever prop. At 2 o'clock, we have the FOMC. Some brokers will not let you trade that ahead of time. Don't care. Top Step has no rules around that. If you want to hold it through, by all means. It's not something that I would recommend, but if that's what you want to do, have at it. Whatever your strategy is, whatever your risk tolerance is, try to work with it. Just make sure that you understand the risk that you're taking. With Apex, for example, one of the challenging aspects of trading with Apex, their combines are cheaper, their resets are cheaper, and their activation fee is cheaper. But you have what's called a live trailing drawdown. So over the course of the day, like for example, on the trade that I took, we ended up down because it hit our stop loss at $753.40. However, for a brief moment, we were up. So I would actually be down on my trailing loss limit by almost $1,000 instead of $753. Top Step has what they call an end of day trailing loss limit, and it trails you up to $0. So when you start your combine, you get a $50,000 combine, for example. You start with a $2,000 loss limit. and you can't go below minus $2,000. Well, if I make $2,000 on my combine, now my loss limit is at zero, but I still have to make another $1,000 to pass. So I need to make sure I don't let that account go below zero at the end of the day, and that's fine, or during the day even. With Apex, it $50, but you lost 750. Now you're down $900. So that's a big difference. Each prop firm has their own nuances. Again, it's your responsibility to make sure that you're familiar with those. And I had I get a zillion questions on a regular basis about this stuff. Somebody's asked me what my plan is for FOMC. I don't have a plan. I'm going to trade whatever the market throws at me. I'm already up really well on the day. I don't want to. I'm not interested in giving anything back. So where did we go here? All right. So yeah, it's just important that you know exactly what your risk tolerance is, what you're up against, and at the end of the day. Um, so it's important that you understand the products you're trading. It's important that you understand the tick value. I will say when you're first getting started, one key benefit is there are two contract sizes on almost every product. You have what are called minis and micros. Minis are the standard size contract and of the size. And it does a couple of things. So if you have a 50K account, where I would never recommend trading more than one contract at a time on NQ or ES because you'll get stopped out really quickly if you trade more than that, or if your stop gets hit, you're pretty much going to be at your daily loss limit if you trade more than that. But you can trade 10 micro NQs for one mini NQ. So if you wanted to cut your risk in half, you could trade 5 micros and say, okay, I'm even trading with half the risk I'd normally. Can be a huge, huge help to what you're trying to accomplish and what you're trying to do. It can really help limit your risk. So that's pretty much it. I'm going to go ahead and end this, but feel free to shoot me questions in chat if you want. You can obviously hit me up in the Oasis chat, and I'm more than happy to answer your questions there. But I will catch you guys later.